Hello and welcome to today's overview meeting. My name is William Rapp, owner and founder of exclusiveannuities.com. And today, more than happy to bring another piece of educational content to you. Today, what we'll be discussing is guaranteed income index annuities with income riders. I think it's important to understand how these particular type of products work in the annuity marketplace, and also being able to identify whether or not you would like to go the accumulation route in your retirement portfolio, or if you would like to have contractual income in your retirement portfolio, understanding the differences between both concepts, and then being able to make a educated decision on how both products work, how both designs work, and really understanding the mechanism behind both concepts. So here at Exclusive Annuities, you can go right to our website. You can speak to an advisor today. My name is William. I am the founder of Exclusive Annuities. What we strive to do inside of our practice is help clients make educated decisions on how annuities work, considering them in their portfolio. And we work with over 65 different annuity carriers here in the nation. We are licensed in all 50 states as well. And we would be more than happy to schedule a strategy session with you. If you go on our website, you can click speak to an advisor now. It will bring you right to my specific calendar, and you can always schedule in a time to have a free strategy session with us at your convenience. Again, my name is William. Here's my business partner and vice president, executive vice president Brady. And you can always go to our YouTube as well. Make sure that you subscribe to our YouTube channel, right? Like and subscribe to our Facebook page as well. Our YouTube channel is filled with videos and educational content to help you make these big decisions during your retirement journey. So today, what we'll be discussing is how index annuities work and the different flavors and different designs that you can implement in your portfolio. And the two topics we'll be discussing today is guaranteed income annuities, right? So this, in a sense, means that you're turning a certain amount of principal into contractual guaranteed lifetime income. You could structure that for single payout. You could structure that for joint payout. And then also breaking down the difference between going the accumulation route as well, and also creating that income stream in retirement without touching your principal. So I think it's important to understand the differences between these two concepts, because sometimes when clients are sitting on meetings with advisors, they might only be being shown guaranteed income, where there's plenty of ways to create and distribute income off of your asset without touching principal, and then also touching principal and having that contractual guarantee inside of the annuity product as well. So this is a proprietary software that we use here at Exclusive Annuities. This is the income calculator. And basically every session that you would have with us, we would use a proprietary software like this that will help us identify every single contract in the annuity market out of all the companies in the United States that will in fact offer the highest contractual income to you based on age, premium, what you're putting into the annuity, whether you're doing single or joint payout. And then there's other components that you can look at as well, as far as performance driven, increasing income, enhanced payments, taking a rider fee, not taking a rider fee, understanding the differences between when you do and when you don't, and also having certain policies that have no income reduction as well. So this is a very important video for you to understand the dynamic between these policies and how they actually work. And I'm more than happy to bring that information to you guys today and dive right into it. So first and foremost, what we are going to look at today is calculating and designing a potential client that would come through, our website, right? Let's just use the state of California, for example, and let's use a 65-year-old male, right? And let's use per se a $300,000 premium, right? So in the software here, we are going to identify the state, the age, the premium, how quick we are going to trigger that income as well. And then if we're deferring, explaining how the deferral mechanism works, and also if we're doing single or joint income. Now, on the software, the no income reduction button, we basically click that on first because certain products have income payments that are high initially and then they decrease over time. We tend to stay away from income annuities like that have decreasing income because with inflation, it makes no sense typically to have increasing income down the road. So we like that either level income or we like increasing income, right? And choosing between level and increasing is really a personal preference, a financial preference. When you're looking at the guaranteed income model, we go through that thoroughly with you and identify if there's a need for increasing income. Some people really like the increasing income because it doesn't essentially solve inflation, but it helps combat inflation over time if your income payout can projectably increase over time. Um, you know, and level income is also, in the discussion as well. So we would go through that thoroughly with you. And if you ever want a customized report, make sure you just go to our website and opt in for a strategy session. We could be more than happy to do a customized report for you as well. But no income reduction for a male. If we were to trigger that income, say right away, he wants to turn his, account of 300,000 into guaranteed contractual income. Typically, we stay away from advisory fee-based products like this, but the first company we would look at would be Gillico here, right? Gillico would be a 23,942 or $40,000 immediate income that you can draw right away, and that's contractual for the rest of your life, right? And if you do the math on that, the way you would look at these products, right? There are some additional benefits from having these type of products, but if we're turning 300,000 into guaranteed contractual income on a 65-year-old, we would want to look on how that math would play out over time. So essentially what would happen is over a 30-year period, you are contractually obligated to that income. They're on the hook to pay for the rest of your life, whether you have an account value or not, which is an important concept to understand. This is what's called a transfer of risk type of annuity, where we're opting in for payments, and it's very similar to a pension or Social Security. The longer that you wait, because a pension and a Social Security is in fact an income annuity, just think about it. The longer that you wait, you contribute, and then the longer that you wait, the higher the payments are. It's the same thing in the fixed index annuity space, right? So when you take an index annuity with an income rider, you're opting in for the contractual payment. So if I take $23,940 and I take that over a 30-year period, right? Living all the way to 95 years old for this example, that means over the long run, you would have withdrew $718,200 over a 30-year period. So in a sense, you're more than doubling your account. It just takes time to take the income back in the full amount of principal that you deposited. So again, this is a transfer of risk type of product, type of design. This is for people that like contractual guarantees. They want to know the exact number that they'll be receiving on an annual or monthly basis. And if you basically structure this for over a 30-year period, your internal rate of return back to you, as far as you putting money in and taking the payment over a long run, is favorable, most of the time, depending on how you look at it. Now, we have some clients that look at this design, and we don't try to push anybody towards these type of annuities, right? But it's good to understand, like, hey, if I have an income need, this is in fact an option, right? An index annuity with an income rider, right? And as you see, that's if we're starting income right away. Now, if we decide we want to defer for 4 years and start those payments on year 5, this is where it becomes competitive in the income space, and other companies will essentially outpace other companies as far as the income payment, right? So we have a list of companies here that would be, a go-to for us to consider based on many different factors that we would go through again with you on a strategy session. For example, whenever we're deferring Equitrust right now, the Market 7 income rider annuity, has a very strong roll-up credit and a payout factor if we're deferring income. So there's three things to consider when looking at the guaranteed income model. Is essentially what happens is you have a benefit base, you have a payout factor, and then you have a contractual guaranteed roll-up percentage, right? So if I look at this particular product, putting 300,000 in, you can see my income-based bonus is a 25% bonus. It doesn't go into your accumulated value, it goes into your benefit-based value. Now, your benefit base is what they use to calculate your guaranteed lifetime income when it's time for you to trigger the income. And you also see that the compounded roll-up rate is 7% contractually for every year that you defer, which means that we can identify and narrow down the exact income payment you'll be receiving based on premium, benefit-based bonus, roll-up bonus, what the payout percentage will be, and then when you're actually going to trigger income. So this, in fact, on a 4-year deferral with Equitrust would be a 36,375 income contractually guaranteed for the rest of your life, right? And it's a 7-year index annuity. Now, also understand with these type of annuities, you're marrying the annuity company. So this is a contractual agreement for you to receive this income payment on a 4-year deferral in a sense of using $300,000, right? If I change this over to joint income, and I could pull up examples on these different products, but say I pull up a joint basis, right? And we defer out, say, a couple more years. I'll wait for the software to load here, but say we're going to defer for 6 years this time, or 7 years, or 8 years, right? Even on a 8-year deferral schedule, say we're putting income away for a little bit longer, you're going to see this market 10 product now with Equitrust is at the top. It's a higher income of 43,000. Now, if you are deferring for more than 5, 6, 7, 8, 9 years, there's other products on the accumulation side that we could focus on to accumulate your asset, right? And create a distribution model off of the asset. I would suggest you guys would watch my Performance Elite Series product training. Watch some of the Midland National Life Group overviews. You'll see how we structure income on an accumulation chassis instead of this type of product, right? But to each his own, right? So this is the guaranteed income model, right? So we know for certain if we trigger income right away, the first payment, highest paying product in company would be with Gillico. They've been around for around 100 years. They're A-. I'll do a quick illustration for Gillico so you guys can understand the concept behind this product if you were to trigger income right away. So heading over to the Gillico illustration software, I'm just going to mimic the exact information that the lifetime income calculator is giving us off a $300,000 premium with a 65-year-old, putting the premium bonus rider on, right? And having the lifetime income withdrawals on year 1 with the joint payout. One thing we do like about Gillico is on an immediate income conversation, they don't change the payout income if you're doing single or joint. So it almost doesn't really matter if we do single or joint, the income will be the same if you're triggering immediately, right? So this is withdrawal starting on year 1. You do have a 5% free premium bonus to this policy right away. And their allocations are special to a degree. You know, they have good allocations on the S&P 500, 1-year point to points, 1-year monthly sum caps. So we like to spread out the allocations to a degree in this type of policy because they are fairly competitive with the Gillico illustration, right? And I'm going to put my name in here, and then I'm going to pull up the actual report, and we can just go through the guarantees, right? So this is a guaranteed income product. This will be the first one that I would show you. The reason I'm showing you Gillico is because right now they are, in fact, the top income paying product. As of this recording, that can change at any time. There's other companies that are competitive if we're triggering an income immediately. But you see there's a $300,000 premium going in, right? It's a 10-year product. We put the premium bonus rider on, and I put the guaranteed lifetime withdrawal benefit rider on as well. Now, what you have to know in this type of account with Gillico, there's a 0.95 fee for the guaranteed income rider. Now, when you take a fee on an income rider, what that does for you is give you a contractual guarantee. Yes, they use the fee against your accumulated value, right? Which is also being indexed in the market because it is an indexed annuity. So if you see the point-to-point strategies we would use with the S&P 500, we have a 10.75 cap on the S&P 500, a no cap strategy with the S&P 500, which is 45% participation. So that means if the S&P returns 20%, you would get a 9% return on an annual basis, point-to-point crediting. So as the indexes themselves are growing your account value, they're also deducting the 0.95 fee because they're giving you the contractual guarantee of the income payout itself. So there's two versions you would want to look at on the Gillico illustration software, right? The first one would be the 0% return scenario. This is what's called the guaranteed contract values. So we have a 300,000 premium going in, and the illustration here would show us what would my income be, what would my accumulation value be, and what would my death benefit be if we had zero returns in the market for the next 10, 20, 30 years. So on the guaranteed ledger, right? And as you see on all of our YouTube channels, we go through, or YouTube videos, we go through the guaranteed ledgers with you, and then we go through the hypothetical ledgers with you to make sure that you understand the difference in the index annuity space on how the payouts actually work and how the growth component works in relevancy to your income. So on a guaranteed basis, 0% return, your income, in fact, is still $23,940. Now, that's a contractual payment, right? It's a contractual payment that you're getting for the rest of your life. However, if we get 0% returns, you'll see your accumulated value goes down and disappears within an 11-year period. After that, they're still on the hook to pay you the income. So that's where you would want to make the assessment. Hey, do I like the contractual guarantees of the income? Or do I want to preserve my asset and take interest off the top as income and never touch any of my principal? So that's what we specialize in here in exclusive annuities. However, sometimes this portion of your portfolio, if it's fit for guaranteed income and we're not too concerned about the account value itself, then the contractual guarantee can win the race in the long run on a guaranteed basis as far as longevity credits, transferring risk, and getting contractual income for the rest of your life. Now, this could be a single or a joint payout, and your accumulated value, in a sense, is relevant to a couple things. The first thing is your death benefit. So if you pass away on year 4 on a guaranteed model, you receive this amount of income, but your death benefit that would pay out would be $207,000. After the 11-year period on the contractual ledger, you'll see that there's in fact no death benefit left, right? And if you structure it for spouse, that's okay because we're not going to have the death benefit payout there. We would have the contractual income continue to your spouse. So that's where it's specific to each client. As far as if you are death benefit focused or spousal income focused, that's where these annuities can play a role for you. The accumulated value typically is also relevant to what's called your nursing home rider or confinement care waiver or rider. So if you go into a confinement care center, right, for a certain amount of time and you qualify for that benefit with this annuity or any other type of annuity for income, what the company will do is they will contractually double your income for up to 5 years as long as you still have an accumulated value left. So if you have an accumulated value, say here at age 78, right, and this matter of fact is the hypothetical look back scenario. With Gillico, there's no income-based bonus or benefit-based bonus. There's no contractual roll-up. It's based off index performance, and that's why they win if you trigger income right away. If you're deferring income for a certain amount of years, typically there's another company, a couple other companies we would look at that have the contractual roll-up guarantee. This is a particular product that would, in a sense, win if you were triggering income immediately. Now, if we get into a nursing home at age 78, they'll double the income for up to 5 years because you still have an account value left. Now, the version we're looking at now is the 10-year look back on how it's performed, and they're projecting the index credits on those indexes that we chose and diversified through, and projecting that into the next 10 years. So this is how the income would work, right? Still the same, no matter if the market does well or does bad. What's relevant to your growth in the policy and the index performance is how long your accumulation value actually lasts, right? So your accumulation value actually lasts through the lifetime of the contract, and then it doubles your income for up to 5 years as long as you have an accumulated value component, right? So if you're not too concerned about death benefit, could be the proper fit for you. If you're not too concerned about long-term care or preserving the asset itself, and you like the contractual guaranteed income, this could be the proper fit for you. Now, this is one company. This is the Gillico proposal, right? There's also other ways to look at this. There's other companies, credible companies that have the same component. For example, the 360 here with Allianz, that's also another design that we could potentially look at. And then you can also check off what it would look like if you triggered that income immediately, right? With no rider fee. So if we want to avoid the rider fee altogether, there's a couple companies that become competitive in that space, right? Again, it's all about the contractual guaranteed income goes lower, as you see when we take off the rider fee. The contractual guarantee is much lower, but you also have preservation of the asset, and you can potentially turn the income on and off and not worry about, the income changing down the road, or the accumulated value draining as well. And then this also can apply to increasing income, right? So this is another way to look at this. If we want no income rider, no income reduction, and increasing income, I have a YouTube video on my channel, Exclusive Annuities YouTube, on the Allianz Benefit Control Annuity. So this is one where you'll have increasing income. There's advantageous crediting to the payout value. It's with an A+ rated company. There's no fees in the product. They have chronic illness income doubler, and also a nursing home income doubler, right? Which you can go back to the YouTube right here. And if you scroll down just a little bit, you'll see the Allianz Benefit Control full breakdown. You can review that product at your earliest leisure if you like the concept of having no income reduction, no rider fee, increasing income. Now, that's basically what we would look at. Midland National also has a good Income Vantage Pro increasing income, and so does National Life Group, right? And I have YouTube videos on all of those products. So if you go to National Life Group, you go to Midland National Retire Vantage, right? You go to the Athene, Allianz, all product educational videos for you to make those big decisions. And you can always consult with us at any time as well, right? Now back to, we're talking guaranteed income, contractual income. So when you take a rider fee and you opt in for contractual income like this, what happens is, taking the fee gives you the contractual payment, right? So if I put this back on single payment, and we take that same premium of 300,000, and we take the state of California, age 65, and now we defer for 4 years or 5 years like we were before, and we take a glance at, the Equitrust Market 7 product that comes up right here with the highest payout, 39,447. What I can do is I'm going to do another illustration on that type of product so you understand how the benefit-based payouts work and the contractual roll-up guarantees work. Now, when we look at the Equitrust illustration software here, I'm going to do it based off the same individual we have in the software, which is a 65-year-old male in California, right? We're going to choose the Market 7 indexed annuity, the same one that lines up with the software, Market 7 income, right? I'm going to put in $300,000. And then the index allocations are also good with Equitrust here. Again, we're on Equitrust because if we're deferring for a certain amount of time, this becomes a competitive product on the income roll-ups, right? So they have a 9% S&P 500 cap. The allocations, right, in an indexed annuity with an income rider, they're not irrelevant, but your income is not based off account growth, okay? And I'm going to explain that more in a second. So I'm just going to illustrate for the S&P 500 at a 9% cap and we'll look at the look back for that, right? And then we had a 5-year deferral. So on Equitrust, I'll trigger income on year 6. And we will pull up the full report and we will go over that thoroughly with each other. As you see, the income payout, right, matches the exact software. So the software tells us if we defer for 5 years with the same data, the income is 39,447, right? And the income is actually the same here, 39,447 with Equitrust. So we're going to pull up the exact illustration here, and we are going to go over exactly how the guaranteed income model works on a deferral snapshot, right? And the first thing, let me go back and share my screen, is the illustration software itself, the illustration itself. So we do like this product on the guaranteed income conversation because it is very competitive. They're beating most companies as of this recording, July 31st, 2024. That could change. But we do that shopping for you, and we would explain how that works. You know, when the rates change, payout factors change, and so on and so forth. When you sit with us on a strategy session, and you can do that right on exclusiveannuities.com. You just press speak to an advisor, and we would love to sit with you and work with you. So again, this is an example of an index annuity with an income rider. Now, as you see, the income rider charges 1.25 in the product, and that has nothing to do with your income. That's what actually contractually guarantees your income in this type of product. So we saw in the software that your benefit-based bonus off a $300,000 premium is in fact 25%. So your benefit-based bonus itself would start, your benefit base itself would start higher than your accumulated value. Now we're looking at the guaranteed version, just like we did with Gillico a second ago, 0% market performance all the way through, right? And what you'd like to understand is the three components that are relevant in these type of annuities, which is your upfront bonus, that's 25% to the benefit base. And then right here is called your roll-up percentage. Now, this benefit base is what determines what your income is going to be based on how many years you defer. So if you are putting 300,000 in, your benefit base increases by 25%. And then on a deferral snapshot, deferral schedule, meaning I'm not ready to take income yet, every year you defer, the contractual agreement between you and the product is that you get 7% simple roll-up credit to that benefit base every year you defer income. Okay. So you defer income for 1, 2, 3, 4, 5 years, you got guaranteed 7% to the benefit base, right? And then it's then going to come down to your payout factor, which on this design is 7.5, right? Based on age. So the payout, the contractual guaranteed income on a 5-year deferral, we know exactly what the number is going to be. It's $39,447,000 a year. So you put 300,000 in, and this is what you collect. So like I said, there's a few ways to look at that, right? If we go back to the calculator and we go type in 39,447 and you live another 30 years, you would have in fact withdrew 1.183 million off of this annuity over the course of a 30-year period, right? While only putting in 300,000. So that's what we like about these type of products. They're a transfer of risk type of annuity. You're transferring the risk over to the insurance company, right? On the guaranteed ledger, that's how it looks. On the non-guaranteed ledger, you'll see that even if we have good index performance, the income itself does not change. The income doesn't change. What changes is how long your account value lasts. And I just explained that your account value is relevant to a few things. The main components there is your death benefit, and then also your nursing home or chronic illness income doublers. So your income will double, in fact, in this policy as well, as long as you're in a qualified nursing facility, right? Or you become chronically ill. So that is the contractual roll-up conversation with Equitrust, right? And that's how the guaranteed income models work when you're deferring a certain amount of years, right? Now, what you need to know is if I go back to the software and I check off no income rider, right? You see a couple companies are competitive here, first being National Life Group on a 5-year deferral. What happens in those type of products, so you understand, when you pay for the fee with Equitrust, you get a contractual roll-up percentage to your benefit base. If you opt in for no rider fee, right, you don't have a fee, but your roll-up percentage is usually determined on how the market performs, right? Very similar with the Allianz benefit control. You defer income, there's no contractual roll-up because we're not taking a fee. It's based off index performance, and some companies have functionalities where if the index returns 5%, they'll give 5% to your account value, but they'll give 10 or 15% to your benefit base. That's how the no fee products type of products work when you're looking to get rid of the fees, right? Have the contractual income, but also blend in the building of the asset in the intern. So this is the contractual income type of product. Yes, there are plenty other ways to create this income without the income rider, but we are in favor for the income rider benefit, right? For the right client. Some clients look at this and they say, this is the best thing I've ever seen in my life. Other clients look at this and they're like, I would never trade my principal for income. To each his own. We don't push you to make any of those decisions or pick one or the other. We do our analysis on what's appropriate, and then we help you make that determination on these are all of the options, right? And we can go to the drawing board and continue to navigate that process to determine the exact perfect contract for you during your retirement journey. Go back to the drawing board here and just look at a few different illustration designs. If we wanted to take a peek at how the income annuities work without an income rider. So I'm going to go ahead and check off no rider fee. Now, if I click increasing income, like we know, Allianz benefit control typically would be a very strong go-to, and I do have a YouTube video on that right here on the page. So for this example, what I'll do is I'll assume we're going to do level income. We're going to trigger it immediately. Now, this is the Income Vantage Pro with Midland National, so I'm going to scoot over here and do an illustration for you guys on this one. Off the same client, right? Male, 65 years old in the state of California. I'm going to do 300,000, right? Index allocations are very good with Midland. In this particular product, we like the annual point-to-point. We'll keep it simple today. We'll just do the annual point-to-point with the S&P 500. And then I'll trigger this income rider coming out starting right away. So I'm going to elect the lifetime payout, and then we're going to start the income right away. So you'll see that on this product, right, if we're taking no income rider, the contractual guarantee is a little lower. So we trade the benefit of having the higher income, potential income with an income rider, trading that for a lower contractual guarantee with hopes of preserving the asset with a contract like this with no rider fee attached, right? So if we look at the Midland National Income Vantage Pro, right, there's no fees in the product. And the first thing that you would want to consider here would be this column down here, right? So the benefit base roll up is 2% plus 150% of whatever the index actually returns at, right? So I'm going to scroll down. You see the S&P 500 cap on an income product like this at 7% with Midland is very competitive on an income product, right? So we do like the Midland National Income Vantage Pro, right? And you're going to basically see the contract guarantee values, the contractual income of that 18,600, right? And you're also going to see on the non-guaranteed or the 5% return scenario, as stated here on the top right, is in fact 5%. So this would show us how the accumulation value would work. And the benefit here, guys, is really the option to turn that. We like this design for people that want to turn income on and off, right? And potentially preserve the accumulated value and the benefit base for either death benefit purposes or flexibility, making sure that there's no fees in the product, but they still have the contractual guarantee of the income, right? So the 18,600 is what's contractually guaranteed if you're triggering the income right away off 300,000, right? And as you see on a 5% return scenario, this account value lasts a lot longer. So from age 65 to 85, we still have $150,000 in the account, which allows us to preserve the principal for a little bit longer. And especially if we're taking income on and off, right, we could potentially be building this account value a little higher with that option, right? So we really like that about the Midland National Income Vantage Pro, right? Very straightforward, no fees, lower contractual guarantee, more flexibility on preservation of the asset. You can also structure this for a joint income or an increasing income, right? So if I switch this over to increasing income and I pull up the same report and I trigger it right away, what happens now is the income will start a little lower, but it will have that crediting that occurs. So the contractual income, if you do level or increasing income right away, the contractual income goes down a little bit more. So while the contractual income goes down a little bit more, the non-guaranteed, which is the 10-year look back on this particular design, is going to allow you to accumulate more income and for it to be higher and higher every year, as you can see on your annual withdrawal schedule. So you could potentially, based off index performance, right, get a higher income as time goes on. This allows for the credits that are applied through the index strategies to actually be populated in your income that goes back to you, right? And the way they do that is every year, 150% of whatever the index performs goes into your benefit-based column, right? Which projects a higher increasing income projectably, as you're taking income or as you're deferring, right? So that's one of the main reasons we do like the Income Vantage Pro with Midland. It's very competitive to the Allianz ABC. The Allianz ABC is a little different of a mechanism. Like I said, I won't go over that one today because I have a whole nother video on that, right? But that's what you need to know about whether or not should I take an income rider fee or should I not take an income rider fee. And just to recap on that, when you take a rider fee, you have a contractual guaranteed roll up. You know exactly what the numbers are going to be when you defer and then take income. If you take an income index annuity with an income rider with no fee, it's predicated on index performance in the interim that's going to determine your income schedule as you take that income, right? So those are important things to know. Now, there's also National Life Group that comes in the conversation. You do have increasing income as well, with Allianz seems to be up there, Income Vantage Pro, Midland National. So those are all product designs that allow you to understand what does it look like if I'm shopping for guaranteed income? Do I take a product with a fee or do I take a product without a fee? It's important to understand these things because sometimes you can think the only product that exists is one with a fee. And that's not always necessarily true. There's good products on the market that have absolutely no fees and can still offer that contractual guaranteed income that you're looking for. And you can also even scratch this off the table, right? You can also go with a pure accumulation product, for example, with any other of our accumulation vehicles that we would help you make that determination during a strategy session. But you can also just go with pure accumulation, right? And for example, I'll change that out for you right here on Midland. And I'll just show you the quick difference between, the Income Vantage Pro, which is the Swiss Army knife type of annuity with contractual income. And then this is what we like to call a flex account. So the flex account is a pure accumulation. So now we're off income rider. There's no income riders in this type of account, right? And again, we can have this discussion on a strategy session, but if we elect annual free withdrawals of 5%, right? And we trigger that from year 2 to year 40, right? Again, nothing contractually guaranteed. There's no income rider in this type of annuity, right? On the accumulation conversation, I just want to show you guys how it looks and how we can design policies with Midland and many other companies. That's where you would want to refer back to the YouTube and check out our latest videos on how the accumulation conversation really works, right? Because if we go with the accumulation route with no income rider, no income, contractual income component, and it's just pure accumulation. There's not a lot of bells and whistles. We can create that income stream by taking interest off the top, right? With no rider fees, free withdrawals, but you're not touching the principal. So for this example, on a 10-year look back, this is a different product with Midland. This is the Retire Vantage product, which again, if you go over to the YouTube channel and you click on this video, I do a whole series on this product right here, the Retire Vantage. The one we just looked at was called the Income Vantage Pro. Okay. So this here on the 10-year look back, hypothetically, you see that you would take $817,000 in income, assuming an 8.8% rate of return all the way through. That's hypothetical. That's history for how the indexes have performed. But you would be able to take that income and still have the asset alive and healthy at the end of the day. That's for people that want to preserve the asset, preserve the death benefit in those scenarios, right? Not a lot of bells and whistles in those types of plans. But today, the general synopsis was giving you information on how to take an income rider or not take an income rider, what the main differences are, right? The difference, like I said, a lot of it is laid out right in the YouTube when you take the income rider. But for example, we have plenty of companies we can go to for increasing income. No rider fee, no income reduction based on your deferral schedule. We will make our assessment on that, and we will help you find the highest contractual guaranteed products on the market, as always, here at Exclusive Annuities. So make sure that you like and subscribe to the page. Check out our website, exclusiveannuities.com. We are here to serve you. My name is William. Click here to speak with an advisor now. That will bring you right to my calendar. And if you go to the bottom, you'll see all of our social medias, right? Feel free to make sure you subscribe and like to the YouTube as well. There's a lot of valuable content here. And we also would really appreciate your support. If you ever want to speak with us, just book a strategy session at your earliest convenience. It's been a pleasure serving you today and going over this material. Good luck on your retirement journey, and we'd be glad to help on the other side if you need us. Talk to you soon.